second now. Kia ora, ngā mihi nui kia koutou. No mai, haere mai. Welcome to this online seminar. We have a great evening tonight. We're joined by Matt Whineray, who's CEO of New Zealand Super Fund. I'll introduce him in 1 second. A few things before then. We'll run for about 30-35 minutes. Initially, I'm sorry to say that your sound will be off, and but you can use the Zoom chat to put any questions in. So write them down as you think of them. We'll pick them up and we'll have a chance to discuss them. Similarly, if you're on Facebook Live, then please enter into the comments section and they'll be taken to us here, and we'll get a chance to answer your questions. The recordings for all of these seminars, I think we're up to number 17 or 18, I think, weekly seminars. They're all on our website, so go and have a look. There's some fantastic seminars there, and we've got more to come. I'll tell you about those at the end. So these are weekly seminars at 7 o'clock on Wednesday. Without further ado, I'm going to say a warm welcome to Matt Whineray. Matt's very kindly agreed to join us. He's a very busy man, CEO of the absolutely huge New Zealand Super Fund. He has a background more in the investment banking world than in institutional funds. So he was for 12 years, has been for 12 years at New Zealand Super Fund, and I asked him for personal information, and as far as I got was that he lives in Point Chef. So for all of those who are Aucklanders who are listening, then you know exactly where Matt lives. So thanks very much, Matt, and warm welcome.
Thanks, Barry.
We thought we'd talk tonight a fair bit about climate change, because obviously it's a key issue, and the New Zealand Super Fund has sort of been somewhat of a leader in producing your climate strategy. But I thought first, maybe in order to paint a picture, if you could give us a snapshot of where you think the New Zealand Super Fund sits by way of comparing yourselves against those who you benchmark against. Maybe the Norwegian Sovereign Fund, maybe other sovereign funds around the world, maybe other large institutional investors. How do you benchmark yourself? How do you sort of judge your performance against peers?
Okay, so we're fortunate in the sense that we don't have to do that ourselves, because the government has included in our legislation a requirement that we have a 5-yearly independent review. And so what happens is every 5 years, Treasury chooses somebody and they come and give us the full exam and report back to the Minister of Finance on how we're doing, and in particular, how we're doing in terms of the obligation in our Act to practice best practice portfolio management. So we get a view of that. And so our most recent one of those was in 2019, when Willis Towers Watson came along and gave us the full 9 yards, and they were very, very complimentary. So they found that we were operating at a best practice level in terms of our people model, our governance model, our investment model. They specifically looked at our approach around responsible investment and delved quite deeply into that, and gave us a big tick as well. So I guess the other thing that we do is each year we benchmark ourselves against the UNPRI. So that's the Principles for Responsible Investment. We were an early founding signatory of that institution. We benchmark ourselves against their their criteria, and we've most recently come out with A's or A pluses from that most recent review. So we think that we do hold our head up internationally amongst these funds that are often a whole lot bigger than us. So you talk about the Norwegian fund. I don't know how big they are at the moment. They're $1 trillion last time I looked, and that's real money, US dollars, not our Pacific Kiwi dollar. So these funds are huge, and you look at the Dutch funds that we also like to look at in terms of their practices. Other funds around the world, GIC in Singapore, the Government Investment Corporation, they're really massive organisations. So we're very pleased that we can punch up there in the best practice world from down here, and that's due to a really committed and fantastic team.
Yeah, good. So moving on to responsible investing or ethical investing, your mandate from the government is to uphold New Zealand's reputation, and as I understand it, you've taken that concept into saying here are a set of rules and approaches and strategies that you will use in order to make sure you do that through your investment strategies. Can you explain to the audience how you go through that process of going from a broad mandate into some more specific rules around what you do and don't do on responsible investing?
Sure. So what the legislation says is we have to invest the fund on a prudent commercial basis. And in managing the fund, we have to do that in a manner that's consistent with best practice portfolio management, what I was talking about before, maximizing return without undue risk, and is also consistent with avoiding prejudice to New Zealand's reputation as a responsible member of the world community. And so it's that last bit that's the important bit from a responsible investment perspective. There's another piece in our legislation that also requires us to have an ethical investment policy. And so what we do is we created the responsible investment framework, and that's the way to give life to that mandate to essentially act in a responsible fashion, which is what that piece of the legislation says. And so what we do with that framework is we try and define, we do define how we will go about that. And we think about the principles of responsible investment, so the UNPRI that I talked about before. Their big point, the big two topics in terms of RI are integration and ownership. So integration means that you're thinking about responsible investment issues, environmental, social, governance factors, all the way through the investment chain, from where you think about your asset allocation to the opportunities that you consider adding to the portfolio, to the managers you select, to the investments that you buy and how you manage them, all the way through. And then ownership is about voting and engagement. So making sure you're an active owner of the companies that you've invested in. And so with that responsible investment framework, where we lay out how we will do those things, that integration, that ownership, we also lay out how we will determine what's important from a domestic perspective, a New Zealand perspective, in terms of exclusions. But I would add now that exclusions, while they become a really big thing in terms of the attention, they are a relatively small part of that whole ESG process in terms of integration and ownership. But we are explicit about what we consider in terms of New Zealand laws, conventions that New Zealand's party to, relevant international law, major New Zealand pieces of policy. So, and then we think about those as we think about what should be in our portfolio and what we won't have in our portfolio from a category perspective.
Okay, so moving on then to the climate change piece of this, you've taken a particular position on your climate change strategy, and can you kind of talk to us about how the climate change strategy came about? One interesting thing for me was you went through the process of saying, is there a kind of a market failure here? markets failing to value fossil fuel companies at their proper value, given their risks that they face for the future. So can you talk a bit about how you looked at that and how you came up to your position on the policy?
Sure. So climate change, it's been quite a journey, and I know that John Mitchell ruined that word for all of us, but I'll use it, on the way to the 2007 World Cup. But the journey for climate change started back with participating in things like the Carbon Disclosure Project, CDP, and then it was quite a challenge to get to sort of get our arms around how to think about it in the context of our mandate that I just talked about, and how we think about those ESG factors in investments. And so back in 2014, I think it was, with a bunch of other investors, we asked Mercer to produce a report, and they produced a report on our website. It's called Investing in a Time of Change, where what they did was they built some models, and they considered the impact of the various aspects of climate change on investment, on corporate sectors, on sectors of the economy, and different countries and different parts of the world. And what that told us was, I guess there was a couple of really important conclusions. One is it's not all the same for all the companies, and that sounds obvious. But there are some positives and some negatives depending on which sectors you're in. But at an overall level, climate change risk, which includes both the risk around transition, so that's sort of call that technology and regulatory risk, and the physical impacts, so acute and chronic changes in weather, those four aspects of risk would cause an overall negative impact on equities, global equities, over a reasonable investment horizon. And so what that said to us is, we're not confident that the investment market is properly pricing this. And let me be clear, most of the time we think the investment market does a really good job at being efficient. Efficient market hypothesis incorporates all the current information into prices. Most of the time we think that's right. Climate change is a bit different, because it's got different impacts on different, depending on which path you go down. And we don't know which path we'll go down. We don't know what the destination is. We don't know if the destination is 1.5 or 2 or 3 or 4, which would be horrific. But even if we knew the destination, we don't know how we're going to get there. And that makes a big difference to the impact on different parts of the economy. And the other thing is we don't know when that's going to happen. So that time horizon is really important. And what we found when we looked at it and talked to investment analysts and looked at research and equity research reports, what we found was we didn't think that the market was doing a very good job of pricing the longer term impacts. So that was important to us, because that second part of the mandate I talked about is maximize return without undue risk. So we looked at this and we said, well, you know what, we think that risk is undue, and we'll call it undue because we don't think we're getting paid for it. We think we own this risk, and we don't think the market's paying us for it. So then it's undue. So we need to do something about it. And we need to do something about it more than just going to our investment managers and saying, oh, hey, can you take climate change into account in your investment decisions? We think, well, we need to deal with this at the asset allocation level. So when I talk about integration, it's not just at the end when you've appointed a manager or you bought a share. We've started at the asset allocation level, and we said, hey, there's some risk in our portfolio. And we define that as, or we proxy that, if you like. We say that risk we can measure by measuring emissions intensity of the different companies in the portfolio, and the reserves ownership of the companies in the portfolio. Both of those risks are important. Emissions intensity, because as carbon prices go up, carbon taxes go up, those things will be worth less. Cash flows will be worth less. Reserves are really important because, as we saw this year, when oil price goes to negative, suddenly stranded assets are very real, right? Suddenly these things that you have
not theoretical anymore, is it?
No, it's not theoretical. You have to pay someone to take it off your hands after you've dug it out of the ground. That's the definition of a stranded asset, right? So we said these two things are important risks, and what we'll try and do is we'll reduce that in the portfolio. So we'll try and take out the heaviest emitters and the largest owners of reserves. And then for the other stuff that we've got, the rest of the portfolio, we're gonna analyze the impact on the different businesses. We're going to engage with companies, so join things like Climate Action 100 Plus or Climate 100 Plus, and we're going to search for opportunities that come from this transition. So the really important thing is our climate change strategy at the moment is a climate change investment strategy. It's addressing the investment risk and opportunities presented by climate change, and and we announced that in 2016, and we've been running that for a few years, or well, 4 years.
So that shifted your portfolio and excluded some of the worst fossil fuel companies.
Yeah.
Looking back at the fact that the Standard & Poor's oil and gas index has dropped by, I looked the other day, 63% over the past 5 years. Do you think you would have done well financially to have moved a bit faster and further than you have? How does it look in hindsight from that decision? Do you think it's been a decision that you've done well from? Do you think you could have done better?
We absolutely could have done better. I mean, I could pick you a bunch of stocks now that if we only owned them, I'd already been.
Yeah.
If at the start of the year I'd sold the whole lot and just bought Amazon and Facebook and Google, I'd be like, we're done.
That was easy.
So hindsight is a fantastic thing, but what we have to do is make decisions going forward in the context of it. So what we did then is we said, we will reduce this exposure. We didn't, how much do we know we needed to reduce it by? Didn't know, thought it needed to be reasonably material, but we're balancing that with what's the impact on the diversification in the fund? How do we think about transitioning to a point where we've reduced this as opposed to going all the way there? Because one of the things that you'll often get is and when I talk to other asset owners around the world, they say, well, the data's a bit ropey, or, how do you know whether your carbon emissions intensity is the right metric? Don't know. The data, except that some of it we have to proxy with industry data. But there's enough for us to start with. And so that's what we did in 2016. We said, there's enough here. Let's reduce our emissions intensity by 20% and our reserves by 40% by 2020. Well, last year, 2019 financial year, we were 43% down in terms of reserves and 52, I think it was, 43 in terms of emissions, 52 in terms of reserves. So we exceeded those targets. And what that did is, over the last few years, that's improved the performance of the portfolio. And I'd said to the select committee earlier this year, so based on the numbers until December 19, that improvement was about 30 basis points a year, which is several $100 million that we're better off as a result of that reduction in our exposure. Now, we'll continue to increase that reduction in our exposure because we think we're getting better information all the time, and we're getting more confident about how we can implement it.
Yeah. And will that include a strong tilt towards renewables and clean technology?
Yeah, so our board is keen on that as well. So not just the reduce piece. So I'd say reduce, analyze, engage, search, but also the search piece, which is where are the opportunities here? And so we've done quite well in recent years in an investment that we made alongside Infratil in a US renewables developer. So they build solar and wind farms and sell them to, once they're completed, to people who want to own these really long-lived renewable assets. And that's been a very good opportunity for us. We are looking at where we've gone into the same type of investment in Europe. I think there's another opportunity there. And so that opportunity to take advantage of that transition, the transition to a low carbon, we think there's plenty more there.
So that's what you've described as primarily a financial decision, that you've reduced your risk and you're looking for new opportunities. As an organization that holds the public's money, do you also feel like you have a mandate to act in ways that will enhance the public good and to basically invest in companies and projects and fund managers who will who will prioritize social benefit as opposed to just financial return? Do you see that as part of your mandate, or do you think you're restricted by the government's framework from doing that?
Well, our mandate's quite clear that we have to invest in a prudent commercial way, but then it gives us those other three limbs that we have to apply as we do that management of the portfolio. The premise is that those things are contrary, and we don't think they always are. In fact, one of our investment beliefs, which is critical for us, is we believe that environmental, social, and governance factors, and including climate change, are fundamental to investor returns. So we have to think about those. But there's a step beyond that, which is the one you're going to, which is, okay, so you're investing for a particular outcome, and how do you reconcile that with the commercial mandate? And that's a bit of work that we're doing at the moment around how do we think about our RI framework now, 10 years, actually slightly more than 10 years since 2008, I think it was, since that was first produced, and it's evolved along the way. Obviously, we added the climate change strategy. How do we think about it now? Where is the expectation moved? Where is the market practice moved? And we're thinking about that, and that move from sort of responsible investment, if you like, to sustainable investment, where you've got more of a consideration of what are those outcomes, and how, the thing that a lot of investors are sort of grappling with around the world at the moment is, how do you think about the SDGs, for example?
Yeah.
And how do you report against those? And it's one thing to report against them, but how do you invest your portfolio to drive particular outcomes?
Yeah, I guess that was kind of the thrust of my question, is really saying, given the fact that you have got in a way a public finance mandate, then to some extent those issues about creating social good, public benefit do kind of have a relevance that aren't always there for a private sector company. And it's a slightly different situation than if you're a normal company that might be trying to earn a few points on corporate social responsibility, but it's quite different for a public finance institution.
Yeah, and we're and the big difference is that we have a piece of legislation and all those private companies don't, and so that's that has to be our anchor and our foundation, and then we think about what our investment beliefs are, and then we step forward from those into, well, what does that mean in terms of how we build this portfolio, and so that is a live discussion, and we're going through that with the board over the course of the next year to sort of reset that RI framework and think about what the next evolution of that will be.
Cool. We'll go to a question, Matt. Paul's written and said, interesting point on how critical company level disclosure is to investors. And I think the point that he's really making is, you said you were working on the basis of information that can never be entirely accurate. And you deal with the information you have at the time. And how do you see that working out as kind of increasingly companies start to report under frameworks like the Task Force for Climate-Related Financial Disclosure, TCFD, whatever legislation we have in New Zealand around that? How do you see this providing a stronger information base? Are you confident that that's going to provide more confidence for you in being able to drive your strategy forward?
Yeah, it will. It definitely will. You don't even go back a few years. One of the challenges for us as we apply that reduce strategy to our portfolio is what we do is we get the data, and we get all of the companies in the portfolio, and we rank them by their emissions intensity as a percentage of sales and by their reserves. And then we just start knocking them out until we get to our desired level. And one of the challenges you have is you don't have necessarily complete data on all of those companies. They're different countries. They've got different standards. They've got of disclosure. And so sometimes what you're doing is you're saying, well, what's the sort of the industry proxy for this for a company that's in this industry? Let's use that. And each year we get better. We get better information, and we get a clearer picture. We also have that same issue when it comes to unlisted companies. So you're trying to proxy those. The way I sort of think about this is when I talk to investors about it, and they say, oh, well, the data's a bit ropey and not sure that your metrics are right and all that sort of stuff. I said, well, you set your whole portfolio up on the basis of an equity risk premium, and we're not even sure what that looks like. The range of, if you go out and poll a whole bunch of academics about what the size of the equity risk premium is, they'll all give you a different answer, and it'll range from sort of 2 or 3 to maybe 7. And yet the entire investment world sets up its portfolios on the basis of some assumption around that equity risk premium and what they think interest rates are going to be. And then they go, okay, so now this is our portfolio. Well, you think about that in the context of climate, we've got enough. What we said is we've got enough to know here that there's some risk. We've got enough to know that we don't think the markets are pricing that very well, but we can go directionally. And so that's how we did that.
Yeah. Good. Matt, I'm keen to learn more about how you coordinate your work with the other Crown financial institutions in New Zealand, with the Government Superannuation Authority, with the ACC, with others. Can you talk about the mechanisms you do that? And because you have a mandate in a way to provide some leadership around work on responsible investing, is that correct?
Yeah, we work really closely. So we want to make sure that we're largely consistent. We're all separate institutions, so we won't be entirely consistent because that's the nature of individuals. But we have a team that is certainly larger than the team at GSF or Annuitas that runs GSF and MPF and the team at ACC on the responsible investment side. So what we do is we provide them with assistance in our work that we do on the RI issues in our portfolio. We meet with them regularly. We also have jointly engaged an engagement outfit called BMO that helps us with our broader and international engagements. And we work pretty closely with those CFIs, and that just makes sense. We should be pooling our resources. We're all Crown institutions. We've all got different purposes, so our portfolios look different. GSF is a defined benefit plan, and ACC is an insurer, but we've all got similar considerations when it comes to how we manage our portfolios and think about ESG issues.
Okay, good. Louise Kong's written. Hi, Louise. Louise says she's interested to hear about the search part of your ESG strategy and the kind of tools, technologies, innovations that can help in that kind of ESG analysis.
Yeah, so we've the search part is interesting because the sort of the scale end of the search is that sort of renewable electricity generation infrastructure. So building wind farms and building solar farms and that kind of thing. There are at the small we've seen some smaller end where there've been private charging networks, particularly in the US, where they're trying to set up these private charging networks to enable electrification of the personal cars, of people's own cars, not necessarily the trucks. We have seen some electrification at a larger scale around buses, and we've seen some opportunities in that space. At the sort of the smaller end, we're not doing that much at that sort of venture end, but we have done some. We've made some investments in in what you call sort of expansion capital. One is in a electrochromatic glass business. So that what that does is produce glass where you can change the opaqueness, I guess, of that and put that on large commercial buildings. And so you're able to control the climate, and inside you need less air conditioning. It's a quite energy efficient approach. In fact, the most recent application of it is those toilets in Tokyo, I think, where you go in and they're transparent to start with, and then you close the door and they they go opaque. So you hope that you don't have a power cut in the middle of that, because it would be you'd be in the middle of the park with no pants on. But the other thing is interesting. Some of the others, we've seen other opportunities through time, different types of generation. We've been shown tidal generation structures, or proposals, and others. But it's quite the scale bit becomes probably the challenge, I think. So we're a roughly $47 billion fund. And so if the board says to us, hey, we'd like to get some more exposure to some of these things that will benefit from that transition, that tends to be the more infrastructure oriented type assets, as opposed to the really funky, new technologies that will be smaller and more.
And it sounds like in terms of analytics and tools, you're using many of the same tools that others would use. So kind of the research houses, the rating agencies. Do you have anything kind of fancy stuff that you do in behind with the research and the analysis that helps you pinpoint opportunities?
Yeah, we built a valuation framework to help our investment teams think about the impact of climate change on specific investments that they're making. We have done quite a bit of work on the impact of climate change on, for example, NatCat, natural catastrophe reinsurance, in the last few years. But that framework is one that I think was quite interesting, and one that we spent a bit of time talking to our Canadian peer funds, so the likes of the Canadian Pension Plan and Ontario Teachers, talk to them about how we think how that should work. And there is a bit of uncertainty because there are, like I said, multiple facets, not just those ones that I talked about before, but the sort of the other two that we think about are litigation risk, and we're starting to increasingly see litigation around climate change. There's a case in Australia against one of the super funds for failing to
That's right. Yeah.
Rest, and the other one is changing consumer demand. I think that's the really interesting one that can be really fast, often a lot faster than these other risk factors. You just see a change in consumer perception, and then that changes valuations in a heartbeat.
Yeah. So Matt, we're going to wrap up fairly soon, but sure, a lot of people sort of want to know what some of your plans are, and maybe you could say that seeing New Zealand's kind of headed for COVID-free status and will be one of the low-risk countries in the world, and with excellent prospects, surely our risk profile is so much lower than any other country, and you can pour more money into investing here. You think that's a good idea?
We've got a fair amount of money invested here. So what are we at the moment? About 13% of the portfolio, I think. If you just went and asked the guys at MSCI how much we should have here, they'd probably say less than 1%. So we certainly think there's some opportunities here for us. And I totally agree with you on the risk profile. I think we'll see people staying a lot closer to home as a result. Okay,
good. I guess we'll have one final one. So Rowan has asked, I'd be interested to hear how you think government policy in New Zealand is driving investment signals to mitigate climate change. So obviously it's kind of ETS price, which is coming up from a very low level. But how do you see New Zealand's framework compared to others?
Yeah, well, I think obviously the passage of the Climate Change Amendment Zero Carbon Act last year was a really important piece, and in particular the agreement across the parties on it, because that provides a bit of consistency. There will always be this through time, but a relative level of consistency compared to our closest neighbours, who will flip-flop depending on who happens to be on the treasury benches. So I think that's helpful. I think everybody that you talk to, all the economists you talk to would say, well, obviously the solution is to price this externality properly, right? So if you're emitting carbon, you're using this commons and you're not having to pay for it, which is the world's ability to absorb CO2. and or the atmosphere's ability to deal with it, and you're not having to pay for it. If you had to pay for it, you would reallocate the capital, and we say, yeah, that's great, but unfortunately that requires a really much better coordinated global approach. And so in the meantime, we hope that individual governments will be able to do that. But the other end is the push that's coming from consumers I talked about before, investors like us, who are changing their choices around where they put their capital, and that's sending signals as well. And I think, that's helpful. I think the direction is good. We're looking forward to the work from the Climate Commission and Rod Carr, because that then makes it really a bit more tangible. How are we going to chunk this up so that by 2050 we can get to that target? And what does that have to mean for different parts of the economy? In terms of where capital goes. So I think that's helpful. I think other countries, there are some countries that are ahead of us. There's some interesting places. Look at France. In France now, investment managers are required to disclose how they incorporate ESG into their portfolio decisions, but secondly, how their portfolio is consistent with France's target in terms of emissions reductions over time. And that's quite a, there's a bit to get your mind around in that question. But that sort of regulation is starting to push investment managers to think a lot harder about it. So, some people are ahead of us. I think some, I would say that probably if you look across the Tasman, the corporates are ahead of the government. I think here it's probably the other way around.
And maybe through the Sustainable Finance Forum that you're playing a leading role in, we'll have some of those good French financial frameworks come into play. Matt, thank you very much. Thanks a lot for all the work you do, and the fact that you've kind of shown some leadership on climate change amongst the CFIs. That's kind of really, really important for not only the super fund itself, but the signal that it sends to other CFIs, and as well as to other investment managers in New Zealand. So that's really, really great. So, and thank you very much for coming on.
No trouble.
Yep.
Nothing else to do.
Yeah. So for everyone else, we've at Mindful Money just had a busy week. We've released a report called Inside the Black Box, and it's an analysis of 280 KiwiSaver funds and 390 retail investment funds, looking at what they invest in. And it's information that's on our website. You can go in there and look at and see what's in the portfolios of investment funds. And the Inside the Black Box report kind of analyzes that and brings it together in a summarized way. Shows that, for example, $6.4 billion of funds are spent on particular issues that the New Zealand public wants to avoid in their investments, like fossil fuels, like weapons, companies that test their products on animals, human rights violations, etc. So go and have a look at the reports on our website. While you're there, you can have a look at our crowdfunding campaign, Mindful Money's charity, and we're running our first crowdfunding campaign. So please be generous in supporting us. And with that, we will wrap up tonight. Next week is the Minister for Climate Change, the Honourable James Shaw. So I hope you're all going to be back to have a conversation about climate change with James. And it'll be interesting talking to him about some of the finance aspects of his climate change portfolio. So final thanks to some of our sponsors for this series, Booster, Harbour Asset Management, and Generate. Thanks very much for the support, and particular thanks to Matt Whineray for joining us. Thank you all. Good night. Ka kite anō.